Welcome to our Capital Markets Outlook. Do markets reflect the political situation? Our analysis would suggest that the impact of politics on the market is short-lived. This means political debates often don't show up in company earnings. But there are exceptions. Think of unstable governments in France, Europe's push to rearm, or the US government, whose unusual policies often shake the markets, especially when it tries to influence the central bank. This kind of behavior does affect markets. Still, there is a positive takeaway. The economy has shown it can handle uncertainty. It adapts. Many past warnings, like the fear of a US recession, turned out to be wrong. So far, this recession hasn't happened. Can investors count on a good economic outlook? Well, this is our base case. We expect a cooling of the US economy in the coming months, followed by a reacceleration over the course of next year. And we expect something similar in Europe. At the same time, we expect inflation to stabilize at around 3% in the US and 2% in the Eurozone. We expect the US Central Bank to cut rates 5 times and the European Central Bank to cut once, all by September 2026. In our view, this should help ensure that long-term interest rates do not rise too much. At the first glance, this sounds like a solid backdrop for financial markets. But at a second glance, things don't look too solid. The US continues to run an annual budget deficit of over 6%, and France and the UK aren't the only major countries with rising debt and little appetite for reform. The better news is that we do think the EU will push forward with the new reform plans. And Germany's new spending plans could boost sentiment. Plus, the AI trend, despite possible setbacks, should stay strong in the long run. Overall, after the turbulent COVID years, we see growth rates normalizing. And that's quite positive for investors. Will bond investors sleep better next year? They will if our core scenario is right. But if inflation gets worse or growth flops, bonds will react first. Worries about public debt are also a potential threat. But as of now, we expect government bond yields to fall slightly in all major markets except Japan. Add to that relatively high current yields, and this makes for a nice package, especially given the relatively low volatility of shorter maturities. Of course, we are keeping an eye on the Fed and any reigniting inflation concerns. Corporate bonds also offer attractive yields, but spreads seem to be at the bottom of their fair value range. We even expect high yield spreads to widen again. Therefore, we prefer investment-grade corporate bonds. Haven't equities become very expensive? We believe that as long as corporate profits keep growing, stocks can keep rising. That might sound simplistic, but it underscores one key point. High valuations alone do not stop markets. Earnings growth has been solid this year. Analysts have raised their earnings estimates, especially in the US, where AI continues to provide a tailwind. We're focusing on second-tier companies and companies that can successfully integrate AI into their business models. However, the US is not the only market drawing attention. A broad global approach may be wise. First, to help reduce concentration risks. Second, because many European and Asian stocks currently look appealing to us. Third, because US equities are once again trading at record high valuation premiums compared to the rest of the world. And fourth, because dollar weakness could reduce returns for non-US investors. Currency fluctuations can have a big impact on returns, and so investors may want to keep them on their radar. In our view, good diversification across regions and sectors remains essential given the risk. Gold and selected infrastructure and real estate investments may help to protect us against unpleasant surprises. But despite all the risks, one thing remains true. Most of the time, the biggest mistake is not to be invested, because in the long run, markets tend to rise.